Greetings and welcome to the Transform Podcast. This is Season 2, Episode 13. Today's guest is Elena Filina, CEO at Svarog Tax Services. In addition to her role as CEO, Elena is a fellow chartered certified accountant who stress tests tax strategies to empower small business owners for growth and balance. Along with her husband Dmitry, a CPA, she started Svarog based on a passion for helping business owners build a foundation that protects their family, fuels their growth, and supports the future they're working towards. Elena, welcome to the podcast, and thank you so much for joining us today.
Thank you, Chris, for inviting. I'm very happy to be here.
Yeah, I'm absolutely excited about this episode. We did have a pre-call, if you will, before coming in to record, and we talked about specifically social media tax strategy. So that's going to be kind of our theme today. And I want to start off with, I guess, a sort of semi-provocative opening here. But, you know, Elena, if you scroll through social media long enough, you're going to hear about how you can write off, you know, your G-Wagon, you know, your dog, your vacations, your entire life. How realistic, how much of that is fact? And how much of that is fiction? If you just had to sort of generally quantify or characterize that.
Every strategy you hear has some real basis. But again, it depends on the situation. And most often, social media, it misses the details. You can write off your dog, but if it's business necessary and ordinary.
Okay. I didn't know you were going to go with the dog example, but that's a great one because most people probably thought you absolutely cannot write off your dog. So I love that you addressed that one. If you had to put it on a scale of 1 to 10, how accurate would you describe tax advice on social media today?
I'd say it about three, not one, but three, because most tax advice starts with something real, like bonus depreciation is real, home office is real, hiring kids is real. But the problem is that social media usually tells you what the strategy is without telling you who qualifies, how to document it, you know, what the limitations are and what can go wrong. And this is where people get hurt. So again, you will hear a lot about this from me today, I guess, that every strategy should survive three questions. Did you qualify? Can you prove it? And does it have a real business purpose? And you know, most tax advice on social media never gets past question one.
Okay, so that came across to me, a novice at this, as an excellent heuristic for approaching a tax strategy. So love that, Elaine. In fact, that's probably going to get clipped and put out as a short for our social media platform. So really appreciate that. If you had to point out the most outrageous tax hack that you've come across, the one that just really kind of made the hair stand up on the back of your neck, what would it be? Or can you even single one out amongst all of them?
The one I see very frequently, based on recent experience from the flow of clients, is S corporation advice. Social media will tell you elect S corporation and save thousands in taxes, and sometimes that's absolutely true. However, what the video doesn't tell you is whether your income is high enough to justify it, what a reasonable salary looks like, what payroll requirements come with it, or how much additional compliance you are taking on. And we had clients come to us after electing S corporation because someone online said it was a tax hack. Sometimes it saved them money, and sometimes the compliance cost outweighed the tax savings. So again, the strategy wasn't the problem. The missing details were the problem.
Gotcha. Yes, I've definitely seen quite a few videos, posts, etc. about S corporation status. So felt that one personally. So let's back up into like why this problem exists in the first place that we're kind of discussing today. Why do you think tax advice has gotten so popular on social media? Why has it become such a popular category there, in your opinion?
It's a very good question, um, because taxes are emotional, right? Taxes feel personal. When someone see their tax bill, they don't think, oh, that's the system working as designed, and we, give our share to the society, right? They think that's my money that I worked hard, long hours, and now they are been taken away from me. And there is a sense of unfairness that's already there before anyone posts a video on social media. So when someone shows up on social media and says, oh, here's how to keep more of your money, that hits something deep. And it's not just financial, it's like, it feels like justice, like finally someone is on my side. So, and also the algorithm actually rewards that. A video that says, write off your car and save 40,000, get 1 million views, while a video that says, it depends on your business use percentage and you need to keep mileage log and, all details and documentation, that video will get nothing. So uh, also, I would like to mention that tax code itself is over 7,000 pages. And then you have a treasury regulations that are supposed to explain the tax code, and they're written in language where you read a sentence 3 times and you are still not sure what it means, and you almost need a translator for the translator. So when someone on Instagram, for example, says it's in 60 seconds with a smile, it feels so easy. And of course, people listen because they want to trust the shortcut rather than to understand the underlying rules.
It's a really interesting explanation for it, Elena. I definitely feel resonance with what you were saying about it's an emotional subject. I was thinking of my own tax bills in the past as you were saying that, so I think you hit the nail on the head there. Do you think, and again, just personal opinion of yours, do you think more of this stuff is intentionally misleading in order to, let's say, reel in a customer? Or is it simply that these individuals or these entities are just going the easy route, oversimplifying what's actually complex? And there's no ill intent there, there's no malice behind it.
Um, that's a good question. I think some people are genuinely trying to educate. They learned something about the tax code, they are excited, and they want to share it. The problem is that compressing something that have 5 conditions, 3 exceptions, and documentation requirements into 60 seconds is very hard. And subject itself is not very exciting. So when you strip all of that, what's left sounds like a universal rule when it was never universal. And it's not just short videos, even a 60-minute YouTube video or a podcast conversation like this one, it can't give you the level of detail that a specific tax situation requires. We can talk about principles, we can raise awareness, we can help people ask better questions, but nobody listening this should go home and restructure their entity based on what they heard today.
It definitely sounds like, takeaway for our listeners at a very high level there would be something to the effect of like, nothing is ever going to apply to me just off the surface. I will always have to have my individual scenario analyzed to then see if there's a fit. So they know then, sort of as a trigger, if I'm skipping the analysis part, I've probably gotten myself into potential hot water or something, to that effect.
100% true.
Yeah, so I think when you mentioned a moment ago about the tax code, the length of it, the number of pages, it kind of made me think of a quote. I forget exactly where I'd seen it. probably from one of these tax gurus out there, but it was something to the effect of the tax code. A very small percentage of it is on paying taxes, and then the rest of it is on ways you can avoid taxes, right? Whether that's true or not, let's just work from that premise for a second. Well, and you can debunk it if you'd like, but do you think that is it that the tax code is actually flexible enough to allow for these creative strategies? In other words, they are actually in there, but somebody has to be very careful about how they attempt to apply it to their own scenario. So, in essence, is that claim true that the tax code is actually trying to help people save taxes, but it's giving them very specific criteria that they need to adhere to?
Yes, and that's exactly what makes this so tricky because the tax code is not a flat set of rules that says you owe this and you pay this. It was designed with incentives built into it. Congress intentionally created provisions to encourage specific behaviors like invest in equipment, hire employees, buy real estate, fund retirement. These are real strategies that exist for a reason. And the code is genuinely flexible for people who qualify and follow the rule. Uh, However, the problem is never the strategy. The problem is the gap between the headline and the execution. Every one of those provisions come with conditions: who qualifies, how much, what documentation you need, do you have a proper structure for it? And the list of questions goes on and on and on. And again, it's not just one section of the tax code, it's like multiple sections that are intertwined. And then, as I said, treasury regs, court cases, all of those.
Gotcha. So I think this is a good point for us to pivot towards, I guess, what we would state as smart tax strategy versus TikTok tactics. Okay, for lack of a better term. How would you describe what a legitimate tax, to a new business owner, somebody who's really coming into this, especially brand new or just totally ignorant of the realities here? How would you describe, or what would it look like to that business owner to actually come upon a real legitimate tax strategy? What does that look like? What does that feel like? How does that unfold for that business owner?
This is very good question, and thank you for asking. Because I would say if a strategy promises massive tax savings with almost no downside, that's usually a sign you should ask more questions. Not because big tax savings aren't possible, they absolutely are, but the biggest savings opportunities are rarely simple. They have multiple moving parts, requirements, risk, and documentation standards that all have to work together. So, my actual advice to business owners in this: before you implement a strategy, try to understand it, ask questions, research it, use AI to help you understand the concept and identify risk you may not have considered. I would never rely on AI for any decision, including tax. But if AI gives you a list of conditions and limitations and risks that the person selling the strategy never mentioned, that should tell you something. So, and again, understanding a strategy and implementing a strategy are two different things. Most of cleanup work we do happens when someone understood the concept but didn't understand the execution.
Interesting. I'm really glad you brought up AI, Elena, because it's definitely something that I think somebody watching this episode would, ultimately, whether before they came into the episode or by the time it was over, they would think about and say, what's the role there? It seems like AI could be very useful at, let's say, identifying a blind spot, if you will. So, like you said, you would never fully rely on it. You'd never just use that alone to make a decision. But if you were being advised, it's a nice check against what you're being advised about. And if you see that gap or that difference, it would kind of be telling. So that seems to be kind of what you're saying there in terms of what AI could be useful for. Is that a good characterization?
Yes. And I mean, it's very good for, I mean, I would tell you that I argue with AI all the time, and it tells you lies, and when you open AI, it says, don't rely. I mean, it can make mistake, and it does.
Yeah.
So, but what it tells you, list of questions to ask the tax advisor, the promoter, the CPA, whomever is selling you I mean, I'm using AI for basically, when I see some kind of advertisement and I'm interested in this, I just like take a picture and ask, is it true? And then I start doing research. I'm not relying on this. I'm start doing the research.
Gotcha. So, you know, a follow up question there would be, in terms of like the tax strategy and how you describe that, is there an income level where you feel like that tax planning really starts to kick in and matter? Is it a totally dependent thing upon the person and their situation, or is there some kind of general level at like, hey, when you hit this number, you should really start thinking about it if you haven't already?
I would say that with taxes, there is no general advice. Um, and I get it. I mean, people expect a number, but the real answer is the planning starts the day you, I would say, think about the business.
Okay.
Not form the business even, but start thinking about forming a business. We see this all the time as corp elections filed before the income justify the cost, entity types that don't match the operation, business owners following advice that was right for someone else's situation, but wrong for theirs. So, for example, we had a business owner form an LLC in New Mexico because someone told him it was better for asset protection. And I get it, it's true. But his business operates in another non-income state tax. So now he is dealing with compliance in two states, additional filings, and cost he never needed. He tried to solve one problem and accidentally created another. And that's what happens when structured decisions are made without planning. Uh, the other, again, why planning is very important because it's the system, it's structure, timing, and building a foundation you can grow. Because we had another client who. mm, uh, got what was that called illegal settlement, right? So and he came to us after a settlement pushed his income close to 370,000, and he came to us in March when basically the tax year is over. So we were able to help him, but not nearly as much as if he had come to us before the settlement hit. And again, we were able to help him because he had some conditions that we can utilize. Otherwise, most of the doors for tax strategies where you can do something, closes on December 31st.
Those are some really interesting examples with the New Mexico LLC one. That was really interesting, and
Wyoming, another one, right?
definitely heard a lot about
Very
Wyoming.
popular.
Yep. I think before I get to the last question of this section, one thing I didn't want to forget to mention, I think, is another great heuristic for our audience to take away. It was in your first answer, and you talked about seeing the downside in a real tax strategy, that there's going to be downside, there's going to be risk, there's going to be things to consider on the other side of the equation. And it seems like to our audience, that could be another quick trigger, like, hey, if somebody's presenting me a tax strategy and it's all roses, it's all positive, a red flag should go up in their mind that, okay, this may
Yes.
not be exactly what it seems. There's no counterbalancing downside to this strategy that I should at least be aware of or should at least understand before I get into it.
Yeah, that's correct.
Yeah, that's
Hmm.
great. Thank you, Elena. So let's kind of finish out with another question or two here. Like, if we had to invert TikTok strategies and say, what are some of the most boring, maybe non social media friendly strategies that are very effective for reducing taxes or limiting a tax bill. Are there any? Are there any that our audience should know about that maybe they're not going to come across on social media because they don't lend themselves to that forum, but they exist?
Um, the most effective strategies aren't the ones people don't know about. They are the ones people don't have the discipline to maintain.
Interesting.
It's like, doing bookkeeping. Uh, I personally don't like doing bookkeeping because it's boring for me and it requires a lot of discipline. You have to do it like constantly, right? Like day to day or at certain period of times, and you have to be very strict about this. Uh, but in tax strategies, for example, if we take accountable plan for uh, for S corporations, uh, so for business owners who are S corp owners, this is how they reimburse themselves for business expenses tax free. But most S corp owners handle expenses the same way they did when they were a sole proprietor or a single member LLC. Just run it through the business and kind of make entries at the year end, and you are done. That doesn't work for S corp anymore because S corporation is a separate entity and you have to follow specific rules. And if you don't, the reimbursement is treated as taxable wages on your W-2, and you pay income tax and payroll taxes on money that should have been tax-free. So you wouldn't see this on, videos on social media about keeping records and submitting expense reports or maintaining documentation. But that's where a lot of tax savings are either protected or lost. And the boring work is the foundation. Without it, advanced strategies have nothing to stand on.
Okay, no, it's excellent advice. Very hard, right, for most people to follow. Hence the point about discipline. Um, Another way I would kind of think of this too, Elena, for our audience's sake, is like, how can they tell if their CPA is planning for them or just filing for them? Is there something they'll notice, or are there kind of indicators that like, hey, I think they're just kind of mailing this thing in, and they're not thinking ahead for me, or they're not incorporating certain strategies that could be incorporated? Is there anything they could look out for in that regard?
I mean, the first thing I would trust your gut feelings. For example, if you have, some uneasiness, like that the feeling that there is something missing. I mean, definitely something is not working in your relationship with your tax professional. But the other way is like, for example, when you call your CPA and say, I'm thinking about hiring someone, or I'm looking at buying equipment, or um, I just signed a major contract. What happens next? Do they ask questions? Do they run projections? Do they explain the tax consequences before you make the decision? Or you just hear, let's talk about it at tax time, or they just completely ignore you? So that's the difference between filing and planning. Because planning starts with understanding the full picture. Your business, your spouse income, your investments, your entities, your goals. You don't prescribe before you diagnose. So, and then you build a plan, implement it, and adjust it as circumstances change. So, and tax return, it just reports what happened.
Gotcha. So a question I was going to close out with, I think you may have beaten me to when you mentioned the discipline aspect, is the real advantage in taxes about creativity or discipline and structure? And so, like I said, I think you kind of answered that already, but just give you a chance to expand upon that if you'd like.
Um, I have a feeling that the audience and you, Chris, already know the answer, right? And it's not the creativity, unfortunately. It's boring discipline and structure every time.
Yeah.
Because tax saving strategies, they are getting very popular right now, and everyone is selling one, and some of them are real, but not all of them will hold up under the scrutiny of an audit, unfortunately, and that's just the reality. And uh, important is that at the end of the day, it's your decision. Every strategy carries some level of risk. A conservative position, aggressive position, that's a conversation between you and your tax professional. There is nothing wrong with choosing to be aggressive as long as you understand what you are choosing. The problem is that people promoting this strategy don't always disclose the risk. They show you the savings. They don't show you what happens if IRS challenges it. They don't tell you about the penalties. They don't walk you through what it takes to defend the position. You make a decision based on half the information. And that's where discipline and structure matter. Not to avoid creativity, but to make sure that before you take a position, you understand the full picture. What you are gaining, what you are risking, and whether your documentation and compliance can support it if someone asks.
Gotcha. That's excellent expansion on the discipline theme, and I think it becomes so evident as I listen to you. I think as the audience is going to listen to you as to how these things often can go awry for a business owner because they lack those pieces, they lack that discipline and that structure that you talked about. I want to do a little bit of a rapid fire kind of myth busting on certain common tax write-offs and so forth. I think I know how you're going to answer these now. Maybe it depends for every one of them, but it would be interesting to just hear your commentary on each one because these are some very popular ones I think that are out there. Let's start off with writing off your car. Is that legitimate strategy or is that usually just abuse by the person driving the car?
I love this one. It's, everybody knows about it, right? It's almost like an anecdote. Um, so let's take a G-Wagon or Escalade or any luxury car. So the video would say, buy something big and expensive, write it off, and save on taxes. And yes, there are legitimate provisions that may allow significant first-year deductions, but before you do anything, there are a lot of questions that need answers. For example, how much is actually business use? Are you using actual expenses or standard mileage method? And which one is more beneficial to you? Who owns the vehicle? You personally or your business? What kind of entity? LLC, S Corp, C Corp? Do you have enough income to absorb that deduction? Do you have enough basis to recognize the loss? How do you reimburse yourself for the vehicle expenses? Are you buying the vehicle because your business needs it? Or because someone told you it was a tax write-off, and I can go on and on. And this is all the some of the questions before we get even to state tax rules. And that's one vehicle, one deduction, and over a dozen questions. And underneath all of them is the one question nobody in those videos ever asks. Is it even economically beneficial for you to take that expense in the first place? Because deduction is not free money. You're reducing taxes on money you already spent.
Something tells me, Elena, that you could have a second career debunking social media tax if I just put the green screen behind it and just tear it apart.
Yeah. Maybe I should do that. It's my internal audit experience, years of internal audit.
I'm almost afraid to ask the next so the next one, can you actually write off your home office? Is that as strict a rule as one might expect? I mean, let's say a skeptic of it, or is it fairly, is there breathing room there, so to speak?
Actually, I like this strategy very much. And in our practice, we consider this strategy as a baseline strategy. One of the first things a business owner should implement if it's applicable to their situation, of course. So, and for most of our clients, we use actual method because it's more beneficial for them, and it allows to deduct a proportional share of your real expenses like mortgage, interest, insurance, and so on. And of course, the bigger your office space, the bigger the deduction. But it has to be exclusive use. So, for example, the office can be like, you can't, as IRS says, you can't watch a TV in there. So it's an office dedicated space. And also, one important thing about this particular strategy is that it opens the door for business mileage write-offs. Because without a home office, your drive from home to your first business stop is a commute, which is non-deductible. And with a home office, the same drive becomes a business trip. So for someone who drives 15,000 miles a year, that distinction alone can be worth much more than the home office deduction itself. So the home office isn't just about the square footage, it's about what it unlocks.
Interesting. Is it true? I could swear I heard this somewhere a long time ago. Can the IRS just stop by your home office and like say, "Hey, we want to see if you're actually following the rules"? Like, how do they know that you've dedicated that space and you're not doing anything else in there?
We've had one client, and he was under audit, and they actually, yeah, came to his house and kind of like looked at his office space, and they found something, I can't recall right now, but some like toys or something, related, and they just denied. They said that it's shared space. So that's why it has to be, dedicated. Especially, I mean, it's easier to maintain this, exclusivity when you have a dedicated office, like a separate room. It's much harder when you have like a table, a corner somewhere in your house. It's much harder.
Yeah. Okay. So there is some truth then to what I heard
Yes.
about that. Okay. What about hiring your kids? Okay, so like, is that usually smart planning or is that usually misused and misunderstood?
Uh, I love this strategy because beyond the tax benefit, it's one of the best ways to teach your kids about business and earning their own money and create their, savings because I mean, you as a parent can invest their earned money into Roth IRA, and like by age 50, they would have like millions tax free, right? But unfortunately, at least my kids, they don't understand this benefit, so they don't want to work. Um, but overall, this tax benefit is real, and the wages are a deductible to the business, and of course, in the right structure. The family can achieve significant tax savings by shifting income from the child lower tax bracket, so sorry, not from, from
Yeah.
their tax bracket to the child's tax bracket. But here is important caveat, right structure, because we had a client who was doing this strategy right. The, kids were doing real work, there was like proper documentation. However, the business was set up as an S corporation. And this is where payroll tax exemption doesn't apply. So they lost 15.3% savings that makes this strategy so powerful. So the strategy wasn't the problem, but the entity structure changed the outcome.
Interesting.
And again, I want to mention also very important that, the standard is real work, fair pay for the age, and documentation, because it's not like 16 or 20,000 dollars a year to 9-year-old because a video told you it was a write-off and you can do it. I mean, I personally don't do it, and we don't. We are very strict with our clients about that.
Gotcha. Okay. We'll finish up with luxury items as business expenses. Is there a line that can be drawn there, or is it just too blurry to risk purchasing things like that under the name of the business?
Uh, there's no such kind of no threshold for luxury items in tax code, right? The IRS doesn't care how much things, cost. The question is two words, ordinary and necessary. Is the expense normal for your industry? And is it necessary for your business? For example, a $5,000 camera for a photographer may be ordinary and necessary, and it will be deductible. But for example, a 5,000 watch or designer clothes, because you wore it to a client meeting, that's not a business expense. That's a personal purchase you happen to wear to work. And courts actually have looked at similar situations and denied the deductions. So I would say the test isn't whether you were to for business. The test is whether the item is suitable for everyday personal use. And if you can wear it outside of work, it's not deductible.
Okay, let's pivot to sort of a cold bucket of water here, Elena, the audit reality check, and talk a little bit about that whole aspect of things. And I think you mentioned something before about how you used to do audits or be involved in that. So this should be great for you. But how, I would say, if you had to estimate it, I'm sure if I Google this, I'd get lots of different numbers. But how often are people actually audited on these types of strategies? I mean, is it a fearsome high number? Is it so infinitesimally small that somebody might be tempted to say, "Hey, they're never going to catch me"? Where would you kind of put that number if you had to take a guess at it?
Um, the real question here is not the number, right? Here is the risk. How likely is it that something wrong on my return actually get caught, right? That's the real question. And a lot of people hear that audit rates are relatively low and assume the risk is low too, and that's not necessarily true. And again, it depends on your risk tolerance, right? But before you ever get to an audit, the IRS actually is matching information reported by third parties against what's on your return. It's like W-2s, 1099s, K-1s, and if something doesn't match, a notice can be generated automatically. So there's no auditor, no examination, just system identified a discrepancy. And that's very important because people think about enforcement, they usually picture an audit. But most IRS contacts doesn't start with an audit, it starts with the letter. So when you hear that audit rates are low, I would say be careful with that number because it can give you more comfort and a greater feeling of safety than you should have.
Okay. Maybe this answer is embedded in what you just said, but what would typically trigger an audit? Now, you mentioned about the matching. How does it actually get up to the level where the human being is like, hey, we need to go in and look at this person's entire situation, or at least this aspect of their taxes? What gets a person to that point where they're subjected to that?
I would say that there are three common ways return gets attention. Like first, it's your numbers stand out. So IRS uses scoring system that compare returns against similar taxpayers, and if your deductions, losses, or other items are out of sync within the industry and income range, that can increase scrutiny. Second, your associations matter. So if your preparer, promoter, or tax strategy comes under IRS scrutiny, the IRS often looks beyond the individual and examines the broader group of taxpayers involved. So that's why, if you pick the wrong strategy and implement it, and it gets, pulled for audit, your risk of being audited jumps very high. And the third is certain strategy, as I said, now attract attention. Every year, the IRS identified transactions and arrangements it believes are being abused. The names change, but the pattern is usually the same. A promoter promises unusually large tax benefits with very little discussion of risk, documentation, or qualification. Also, I advise people read Dirty Dozen by IRS because some of the strategies they highlight there, and which, as I said, they change names, they change products or whatever, but the underneath idea is the same. So it can help people to sift through the uh, crap. Oh my God. I, should, I shouldn't have said that.
Well, it's up to you, Elena. We can clip that. So, so
Oh
that
God.
the Dirty Dozen. I actually think I've seen it's on their website, right? It's a
Yeah.
okay.
Hmm.
So that seems like where somebody could find, like, if they were thinking to themselves, like, hey, what are the red flags that the IRS will catch on my return? It seems like that's a good place to at least start. Where you can see some of the typical things that they would look for, zero in on. So that's super helpful to our audience. Um, what does it look like when you when you get notice of an audit? Is it a letter in the mail? Does somebody knock on your front door? Like,
No, no, no.
you know,
It's like it's regular letter that
okay.
IRS sends, and they usually request the information. So and what's interesting about this is that it doesn't mean something wrong, right? It doesn't mean that you abused or didn't follow the rules. However, um, in most of these kind of mm, screenings, they are resolved through letters. However, it opens uh, the door for more questions, right? And once I rest inside, can the scope change? Absolutely. One issue opened the door, and what's behind it determines how far they go. And that comes back to the same three things: compliance, documentation, and business purpose.
It seems, Elena, like um, if a person is in a do-it-yourself mode for taxes, that once that door is opened, it's probably not going to get closed very quickly. It seems like once there's a thread to pull on, there's probably the whole thing is going to come apart. It just in most situations, I don't want to say that universally, but if somebody's been kind of winging it and coming up with their best guess at these things, once they get that audit letter, it feels like it's a house of cards ready to kind of come down. Now, if you're defended by somebody like your firm or a professional outfit, that's much less likely. I mean, there's going to be defensibility to things and stuff like that, but it gives me the feeling that people who think they can go their own way on this sort of subject, let's say based on social media or a book they read or something like that, that once they get that audit letter, it probably goes more bad than good from that point forward. So I don't know how well that tracks with your experience, but it just sort of feels like that as you answered that question.
Um, I would say that most of our clients they come to us with such letters, even if it says that something wrong with your, like, I don't know, $50 amount. So even such small amount, they come to us because they want to deal with IRS, period. And again, I would say that mm, it depends on the complexity. The more complex your tax situation is, the more complex tax strategies, the more complex accounting you use for your business, the higher risk that, one thing will kind of pull the other.
Gotcha. Gotcha. Do you think, you know, from your experience, Elena, is the real risk the frequency with which somebody could be audited, or like the penalty once they are audited? If that makes sense. Like, is it, do you understand where I'm going with that?
Yeah. I would say that most people focus on audit rates, but I think they're focusing on the wrong number. Because the bigger question is what happens if the IRS disagrees with you? And if the IRS finds you underreported income or claim deductions you can't support, you don't just pay the tax you should have paid in the first place. You pay tax, interest, and penalties. And those penalties, they vary, right, based on what it is. If it's accuracy related penalties, which most of uh, business owners or taxpayers in general, abiding rules would get is like 20%. But also, certain valuation related penalties can be significantly higher. And if the IRS determines fraud was involved, the penalties become much more severe. So that's why, I stress test, the advanced tax strategies to kind of avoid the strategies that kind of very alluring, because I want my clients to save on taxes. I want to make my money. But again, I don't want them to pay, such severe, because I mean, it can be like 70% and higher,
Yeah.
you don't want that.
So it kind of, not to say this was your intention, but it seems to
It's
support.
scary, right?
It seems to support some of the people I see on the other side of this equation who are like, look, I'm just going to pay the maximum amount of tax that I could conceivably owe because I never want to take this risk. Like, I never want to get anywhere close to this. I never want to see a letter with that eagle in the upper left corner that says, hey, the IRS has a question for you. So, I mean, it's kind of, I think there's a self defeating aspect to that, don't get me wrong. But to your point, that, the audit rate might be this big, but the punishment if you're off is this big is probably why some people are like, I'm not even going to mess around with it. I just want to just pay everything I think I owe and then some and just walk away, from the situation. And it's just interesting how that dynamic can develop just from, like you said, the severity of getting the situation wrong and being on the wrong side of the equation.
That's why, the tax planning with a trusted tax professional, is very important.
Yeah.
Because, I mean, trust is important in every relationship, in any industry, right? So I just suggest, finding tax professional through the trusted referrals, like, and again, be careful because we had, I can't keep it to myself, but we had a client, who did through trusted referrals or whatever. He was not he was like a tax preparer. He was helping clients to to fill the form, but he'd never signed, so his name was never anywhere on the document. uh, but what he did, he written off the uh, house they bought for the business, like completely. And I said, I mean, how can this be? Because it's the asset. You can't just write it off completely, you know? So, I mean, some situations like this can happen. So you have to do your due diligence same way as you do due diligence on doctors. You don't go to the first one available, right?
Yeah.
You just like check the credentials, meet with them. And so that's very important.
Okay. Um, that's super helpful, and I think I'd close this part of our discussion about audits just by asking, can you clarify for people like how far back the IRS can actually go? Like once they've kind of, like you said, opened that door, how far back can they look at your records, your tax returns, things of that nature? Is there a set timeline? Does it kind of depend on the situation?
It's interesting. Today I had a meeting with several business owners, and we talked about the tax strategies, and they actually thought that IRS can only look at last year, and I said no. The reality is 3 years from the filing date. Substantial understatement of income is like 6 years, and fraud is no limit. So basically, you're on the hook.
Kind of like a blank check there for
So
them if they
we are
decide.
going, yeah, we are going back to the three main aspects, right? Compliance, documentation, and business purpose.
Oh, this is outstanding, Elena. This is going to be so helpful to our audience. I wanted to, go on for about an hour or so here. I wanted to kind of close with just some sort of rapid fire, quick questions to close some loops. Um, and again, these may be deeper dives than I first planned based on how thorough your responses have been to these things. What do you think the most overrated tax strategy on social media is? I mean, is there one that just, you've seen it and it could apply, but it's overstated in terms of how effective or how good it can be for a business owner?
I will be brief, and I would say that any strategy that promises massive tax savings without talking about risk, documentation, or qualifications is overrated.
Gotcha. And is there one thing that you've kind of sensed or seen in your experience universally that every business owner should maybe like check and see, like, am I doing this, and just stop doing it immediately? Some kind of bad habit or some kind of inclination as far as taxes go that they probably are doing and they should stop doing immediately.
I would say making tax decisions alone. What works for someone else may not work for you. So I would definitely, especially with complex situations and a lot of money, I would find a trusted tax professional.
Yeah, this sounds like outstanding advice. Um, and maybe the inverse of it, what's one thing they should start doing this year? Is it bringing somebody on board who understands these things, an expert in the area, or something to that effect? Or is there something even more basic, more simple that they can immediately implement that they should start this year?
I would say that get your foundation right, like entity structure, bookkeeping, documentation, because before you chase a single advanced strategy, make sure the basics are actually in place.
Excellent, excellent. And what about if someone, let's say they have followed bad advice, they saw something, they did it, they now realize they shouldn't have done it, it's kind of bad for them. What can they immediately do next? What should be the next step that they take at that point in time?
I would say don't panic. IRS is not knocking on your door, but I would definitely get a second opinion from a qualified tax professional and figure out what actual exposure is. Because sometimes the problem is smaller than you think, and sometimes it's bigger. And that's why you need facts before you need fear.
Interesting. I think I'd close with sort of a philosophical question. Just listening to you over these last 50 or so minutes, Elena, and I think for our audience too, they're going to realize how textured, how intricate this actually can and should be approached. And it feels like when you now take, like, say, your appearance on this podcast, you put it next to one of these social media 2-minute videos about saving taxes, it really feels like people who do that, who create those sort of things, they've really opened up significant liability potentially for their listeners, their audience. And it makes me wonder out loud, especially after this conversation with you, like how responsible they should be held for doing that. I mean, just your example. Let's say how you broke down the vehicle write-off. How you step by step through that, and how thorough somebody needs to be to do that properly. It really feels like people who go out on social media and just sort of throw these things out there, they're really opening up a liability possibility for their audience. And how closely linked to that liability should they be? It's perhaps a rhetorical question for you, but it definitely comes to mind as I listen to you today.
Uh, y- you know, they create attention, which is good, right? Because people know and learn about all these strategies. But the truth is, the liability usually lands with the taxpayer, and that's uncomfortable part.
Yeah.
The creator gets views, and the taxpayer signs the return.
Right. You get
So,
the letter from the IRS.
yes, for the start. So yes, I mean, content can influence bad decisions, but at the end of the day, the taxpayer is the one who has to defend the position. So because the information is available to everyone, but the consequences are individual.
Gotcha. I think that's an excellent uh, viewpoint for us to close with. So I really, really appreciate that, Elena. And I think this episode in its entirety is going to be one of our most useful or most helpful, I think, to the audience. Particularly people who are in this space and dealing with these sorts of issues. So I cannot thank you enough for the time today that you took to share all this with us. Where can the audience find you, Elena? If they want to engage more with you or enlist your services, where can they find you, and what should they do next?
It's Svarog Tax Services. Uh, we are on LinkedIn, Facebook, Instagram, and website is svarogtaxservices.com.
Awesome.
Yes, please come and get second opinion at least.
Awesome, awesome. I urge them to do so, particularly if they fall into one of these categories that we talked about today. Well, thank you again, Elena. I think there's probably grounds for perhaps a follow-up episode in the future, so hopefully you'll come join us again down the road. But thank you again for joining us today.
Thank you, Chris. It was very scary. I think now when I I see your reaction, I think it's very scary, and I don't want to be. I just want to make sure that people are actually aware that tax is not simple subject,
Yeah,
and CPAs and EAs and tax professionals, they exist for a reason because they take trainings and long exams of CPA and other stuff. So it's just very important to rely on trusted sources and do due diligence themselves so they understand what the risks are.
excellent. That's excellent clarification, Elena. Thank you again so much for joining us today, and we hope to see you again soon.
Thank you.